For those that were worried that there was another shoe to drop in the 1MDB scandal here at Goldman Sachs, did David Solomon put those concerns to rest?
Well, I'm not sure about that. I think he's talking about the quarter and the business, so we'll see how that develops. I think that's a totally separate issue. I don't know enough about what's going on with that to really make a judgment that it's over. But the presumption is that the current business conditions are good and they had a good quarter. And I guess there's good volatility and bad volatility. I think J.P. Morgan had some bad volatility in their investment banking numbers. And, of course, Goldman had the good volatility. So volatility isn't always good, but it certainly was evident in the quarter.
So when he says that there was a sort of de minimis effect in terms of customer accounts and on the business as a result of the scandal, I mean, this is a pretty big move in Goldman, David, up almost 10%, lifting the entire Dow. Would you buy, or are you still wary?
Well, I own the stock and the funds, and I think it's one of the premier names you have to own if you want to be in financial services. But remember, the stock was $275 not too long ago. So again, the whole group was doing nicely in September, got incredibly beat up into year end or into Christmas, and now it's rallying. So, what is it, up 17, 18% for the year? So we've had like full year performance in 20 days or 17 days of the year. So it seems a little bit like we got ahead of ourselves on the downside around Christmas, and now it seems like we're ahead of ourselves on the upside. Business is fine. The question now is, the stocks are now reflecting everything's good again, which is what they were doing in September. So, the business is fine. The question now is what, these stocks move so rapidly up and down, it's hard to really make sense of it sometimes.
Fred,
I've never seen it before.
The returns we've seen from some of these banks have improved a lot over the last year or so. Does that justify the share price performance, and does it suggest moving forward that sort of regardless of whether we do see a bit of an economic slowdown, that they can keep making money?
I certainly believe they can. I mean, this is the big move that year over year, though, had a lot to do with the taxes. So you don't want to get away from that because the growth rate of earnings will slow. But you have to remember the balance sheets of the financial system today is in much better shape than it has been really ever in many ways. And the underwriting since the financial crisis has been strong. That's what wasn't reflected in what David was talking about, that downdraft that we saw in the fourth quarter. And we're getting that back.
What is your top pick, Fred, at the moment? I mean, it's been fascinating to see the size of the moves this week. J.P. Morgan outperforming last year is the relative underperformer of the big banks this week.
Right. Well, at this point, I think it's best to position more towards the smaller and mid-sized banks because we knew coming into this quarter we were pretty optimistic on net interest margin and loan growth. That's coming through in the big banks. The trading's been, as was talked about, a little bit all over the place. So I think it's concentrating on the smaller and mid-sized banks. We really like MTB right here. And I would buy a basket of the smaller banks, such as the KBW our regional bank ETF.
So, David, I know you mentioned you have Goldman in the fund, but it looks like you have much more sizable positions in J.P. Morgan, Bank of America. Why is that?
Right. Well, I think I'm not a huge fan of the trading business. I've been on this program before saying that's a low PE business. I think the banks the bigger banks offer a better mix. I've been saying something like Goldman, they need to buy like a Wells Fargo to compete with a J.P. Morgan and a Bank of America and to some degree a Citicorp. They won't do that economically probably, but they need to build the deposit franchise. And I think that's the asset that is allowing these banks to do so well now. If you look at the large banks, they've got roughly half of their costing liabilities at 40, 50 basis points because those are the core deposits. And so that's what's allowing them to expand margins and make these kind of numbers. As where Goldman doesn't have that. They're trying to build it on the internet and so on and so forth. It just doesn't have the same value as these large banks have.
Fred, talk to us about whether fintech is a opportunity for the big banks or a threat. I guess we saw another little merger, a deal today. We also saw in the Bank of America numbers some remarkable digital banking numbers. So does it help the big banks or hurt them?
I think it's really both. What we're seeing in this industry happen is there's an integration going on of the new technologies into the big legacy players. On the one hand, there is some disruption going on. On the other hand, the way that disruption is playing itself out is it's being incorporated into some of these big institutions like Bank of America. So overall, we think the big banks And even the small banks with the merger today can be pretty well positioned to continue to serve their customers well by adapting and incorporating this technology.
What about Morgan Stanley, Fred, very quickly, coming tomorrow? Do you think they can beat in the same way that Goldman Sachs has?
As David was just saying, with this trading, it's very difficult to say. That said, I think all these institutions have been set up pretty well to beat very low expectations coming into the quarter. I'm hoping we'll have some follow through tomorrow, but hey, we had an awfully big move today.